0 days to expiration or 0 DTE options are contracts that expire on the same day they are traded. These options exist for many underlying assets, including indices like the S&P 500 and individual stocks. Because they have such a short lifespan, 0 DTE options experience rapid time decay and can exhibit significant price swings in response to market movements. For active traders, 0 DTE options present unique opportunities and challenges. They allow for leveraged exposure to short-term market moves, but require a solid understanding of market dynamics, volatility, and risk management. Without proper strategy and discipline, traders can quickly face significant losses. Understanding these options is crucial for those looking to capitalize on short-term price movements efficiently. 0 DTE directional options are contracts with no remaining time to expiration, meaning they must be executed or closed before the end of the trading session. Traders use them to speculate on intraday market movements, making bets on whether the price of an asset will move up, calls or down puts, before expiration. Unlike standard options, which may have days, weeks or even months before expiration, 0 DTE options have only hours or minutes left. This results in faster time decay, also known as theta decay. The value of these options erodes quickly. Higher sensitivity to price movement or gamma exposure. Small price changes in the underlying asset can significantly impact option pricing. Increased risk and reward potential. Because of their short lifespan, traders must act swiftly, making risk management a priority. Many traders are drawn to 0 DTE options due to their unique advantages. Immediate feedback. Since expiration occurs the same day, traders quickly know the outcome of their trades. Frequent opportunities. Many underlying assets offer 0 DTE options multiple times per week, providing regular trading setups. Leverage with limited capital. Traders can gain exposure to significant price movements with relatively small capital outlays. Because of their rapid price movements and high gamma exposure, successful trades in 0 DTE options can yield substantial returns within minutes or hours. This makes them attractive to day traders and scalpers looking for short-term gains. While the potential for quick profits is enticing, 0 days to expiration options are inherently risky. Extreme volatility. Prices can fluctuate widely, leading to rapid gains or losses. Little margin for error. Unlike longer-term options, there is no time for recovery if the trade goes against the trader. Risk of total loss. If the option expires out of the money, it becomes worthless, resulting in a complete loss of the premium paid. Traders must approach 0 days to expiration options with a well-defined strategy, strict risk controls, and an understanding of market conditions to maximize their chances of success while mitigating potential losses. Scalping focuses on executing multiple quick trades to capitalize on small price fluctuations, requires a keen eye for market movement and often involves tight stop losses. Typically utilizes high liquidity assets such as SPX options to ensure smooth entries and exits. Best suited for traders with strong discipline and experience managing fast trades. Momentum trading involves entering trades when a stock or index shows strong directional movement. Traders use indicators like moving averages, RSI and MACD to confirm trends. Aims to ride the trend for as long as momentum holds but requires quick exits when momentum fades. Works well in trending markets, especially after a major breakout. News-based trading capitalizes on price swings resulting from economic data releases, earnings reports, or Federal Reserve statements. Requires traders to anticipate market reactions to scheduled events. Often involves both call and put options like straddle or strangle strategies to hedge against uncertainty. Can be highly profitable but also risky due to unpredictable reactions. 0 DTE options offer high reward potential, but they also come with significant risks. Due to their short lifespan and extreme sensitivity to price movements, traders can experience rapid gains or losses within minutes. Effective risk management is crucial to avoid catastrophic losses and ensure long-term profitability. Without proper risk controls, even experienced traders can quickly wipe out their accounts. With position sizing, you limit exposure per trade. Risking too much capital on a single zero DTE trade can lead to devastating losses. A common rule is to risk no more than 1 to 2% of total capital per trade. Adjust based on volatility. In highly volatile markets, reducing position size can help manage risk. Use defined risk strategies. Spreads, such as credit spreads or iron condors, can limit potential losses while still allowing profit opportunities. Apply stop-loss orders to set predefined exit points. Using stop-loss orders can prevent large losses if the trade moves against you. Use percentage-based stops. For example, cutting losses at 30 to 50% of the option premium can help preserve capital. Avoid emotional decision-making. Sticking to predetermined stop levels prevents holding on to losing trades in hopes of a reversal. Apply hedging to offset risk with opposite positions. Use spreads to reduce risk. Diversify across multiple trades. Traders can hedge directional trades by purchasing protective puts or calls. Use spreads to reduce risk. Trading debit or credit spreads instead of naked options limits downside exposure. Diversify across multiple trades. Instead of going all in on a single trade, distributing risk across different strike prices or assets can reduce overall exposure. Successful 0 days to expiration trading requires a strong understanding of market conditions. Traders should look for high volatility. Increased price movement creates more opportunities for profit. The VIX, or Volatility Index, can help gauge market sentiment. Strong directional trends are also crucial. Markets trending up or down provide clear trade setups for directional plays. Breakouts and key levels are important too. Trading near support or resistance zones, moving averages or Fibonacci levels can provide high probability setups. Lastly, liquidity and volume matter. Heavily traded assets such as SPX and QQQ ensure tighter spreads and better execution. Technical analysis plays a crucial role in spotting 0 days to expiration opportunities. Key indicators include moving averages. The 50-day and 200-day moving averages help identify overall trends. The 9 and 21-day exponential moving averages are commonly used for intraday momentum. The Relative Strength Index, or RSI, measures whether an asset is overbought or oversold to signal potential reversals. The MACD, or Moving Average Convergence Divergence, confirms trend direction and momentum strength. The VWAP, or Volume Weighted Average Price, helps identify institutional buying and selling levels for intraday trades. Bollinger Bands show volatility expansion and contraction, useful for identifying breakouts. Since 0 days to expiration options react sharply to market-moving news, traders should stay informed about economic data releases. Reports like non-farm payrolls, CPI, which is inflation data, and FOMC meetings can cause significant price swings. Earnings reports are critical too. Company earnings announcements can create major volatility, making it crucial to plan trades around them. Federal Reserve statements, including interest rate decisions and Fed comments, can rapidly shift market sentiment. Geopolitical events are also key. Unexpected events like wars, sanctions, or policy changes can disrupt the market, creating sudden volatility. By analyzing market conditions, using technical indicators, and staying informed about news events, traders can make more informed, 0 DTE trading decisions, improving their chances of success. Case study number 1. Riding momentum on a breakout. Setup. A trader noticed the S&P 500 breaking above a key resistance level at 4,500 with strong volume. Indicators used 9 EMA and 21 EMA crossover confirmed bullish momentum. RSI stayed above 60, signaling continued strength. Trade execution, bought S&P 500 0 DTE call options at $5 per contract when the breakout was confirmed. Sold the contracts at $12.50 an hour later as the price surged higher. Outcome, 150% profit in under 2 hours. Lesson learned, waiting for confirmation of a breakout with volume and momentum indicators can increase the probability of success. Case study number 2, news-based trading on CPI release. Setup, the Consumer Price Index report showed lower than expected inflation, leading to a strong market rally. Indicators used pre-market futures jumped significantly. VIX dropped, signaling bullish sentiment. Trade execution entered SPY 0 DTE call options at market open, anticipating continued upside. Closed the trade for a 100% gain in less than 30 minutes. Lesson learned: economic reports can trigger massive price swings. Case study number 3. Overtrading and ignoring stop losses. Setup. A trader attempted to scalp a market reversal after a strong downtrend but ignored clear bearish momentum. Mistake. Entered a SPX 0 DTE call option too early without confirmation. Held the position as the price continued to drop, instead of cutting losses. Outcome: the option expired worthless, resulting in a 100% loss on the trade. Lesson learned: always respect stop losses and wait for proper confirmation before entering a trade. Case study number 4. Holding through major news event. Setup. A trader entered in SPY 0 DTE put option ahead of a scheduled Federal Reserve announcement, expecting a market drop. Mistake. Failed to account for potential whipsaw price action after the news release. The market initially dipped but quickly reversed, stopping out the position. Outcome: 70% loss due to poor trade timing. Lesson learned: major news events can create unpredictable volatility. It's often better to wait until after the announcement to trade. By analyzing both successful and unsuccessful 0 DTE trades, traders can refine their strategies, improve risk management, and increase their overall profitability. 0 DTE trading is not for everyone. It requires discipline, experience, and a strong risk management strategy. While the potential for quick gains is appealing, traders must approach it with caution, only risking what they can afford to lose. By continuously refining strategies, analyzing market conditions, and implementing strict risk controls, traders can enhance their chances of success in the fast-paced world of 0 DTE options.